All right, guys, thank you so much for watching this video. We have a special guest, someone that I personally look up to, and I really, in my career, actually want to be like John Carter. John, thank you so much for accepting. I met you first I think in 2019. You did a presentation in Money Show in New York City, and I was just amazed by the way that you presented your trades and concepts and the way that you handled the crowd. And I was just absorbed, and I said, oh, that's the person that I want to become like that, because I've always looked for a mentor. And obviously, you know, you're one of the very pioneers of active trading with your book, Mastering the Trade. I personally read it. Amazing. Thank you so much for accepting to have this conversation with us and our community.
For sure. And I think it's always great. I love the different communities that are out there in the trading world. And, I think anything where anybody that's out there working together with retail traders and kind of, pushing them towards the freedom of being able to trade for a living and get out of the rat race and whatever that means, I think it's great.
Oh, thank you so much. So I have one question. John, I know you are a very good option trader, probably the best options trader that I know. Have you always started with options trading, or you actually gradually switched to options? And why options trading?
Yeah, so my first trades were in options, and I didn't really necessarily understand them. But I started off, uh, as a early 20s, late teens, early 20s, just kind of placing some trades, didn't really understand what they meant. I would try stocks, but the stocks weren't that exciting. I could buy 100 shares of stock, or I could buy 10 calls, right? And I really got into the idea that with the leverage and everything like that, I really like that. And then from there, as everybody knows, when you start off in options, at first it seems like in the beginning you always make money because you don't know what the hell you're doing. And then at some point it's like, wow, why isn't this working all the time? And so then it was kind of this journey of what what's going to work for me, what kind of option trading is going to work for me. And generally it kind of gravitated towards the idea of what I call chart based option trading, meaning, I'll look at a chart, I'll decide that the edge is to the upside or to the downside, and then pick an option based on the chart versus pure, looking at Greeks. I take into account the Greeks, but I'm not making a trade just based on just the Greeks.
Oh, very nice. And John, do you usually most of the times like pick direction, making directional bets and going long ball, or are you also like a premium seller as well in your trading?
Yeah, so it's a little bit of both. So, it goes, my preference is just because of the kind of the risk to reward and the bang for the buck is to look for those setups where, you're going to be able to ride either a nice trend to the upside or to the downside and just sit on it. And what I always like about trades like that is that you really just have to focus on one thing. And a lot of times that's just learning to manage your own anxiety. It's like, okay, it's up, it's down, but ultimately just letting the trade play out. Now I like SPX trades, like the 0 days to expiration, all that, and a lot of that is more premium selling based. So I do like premium selling. Typically, if it's a day trade or a couple of days, I'm definitely not someone who wants to sell premium 60 days out and buy it back 30 days. That's a really great way to trade, by the way, but it's a little too boring, I guess, for what I like to do. So I think that combination. And in a perfect world, if you've got a swing trade where you throw on some long calls, sell some put credit spreads to offset that theta decay, and it's a nice kind of a mix.
It's kind of just staying on this topic because you mentioned something, Andrew, if I allow, if I want to dig a little deeper on the risk to reward. And of course, option trading has really exploded in the last few years. And one of the really favorite strategies everyone talk about is just premium selling. And at least in our community, we often say, the risk to reward is very asymmetric because, your reward is the premium you sold, but the risk is a massive, let's say 20%, 30% gap down. So that's not really a long-term sustainable strategy. And it's very interesting, coming from a pro like you, that you're more of a buyer of options. How do you see kind of the educations in the last few years with the boom of retail trading? Where do you think the option trading education is at the moment? Are we in a good spot, or do you think there's more work to be done?
Yeah, so those are all great observations and great questions. And I think, what happens a lot of times in the life of a trader is they start off buying calls because that's kind of that makes sense. And then it's like, wow, that didn't work. So then they start maybe selling premium. And you hit the nail on the head. And the toughest thing with selling premium is it's attractive because let's say you're selling a 2 standard deviation spread, right? It's going to win 94% of the time. with literally hardly any headaches. But that 6% of the time it doesn't work, you're kind of like risking 15 or 18x to make that one. It's okay if you know how to manage that, but it's a pain, and it can ruin your day, it can ruin your week, it can ruin your month, really. And I think that, in terms of, your question about, options education, I think honestly sometimes there's too much emphasis on selling premium. It's like the idea is, oh no, you gotta be on the right side of the options. But the thing about it is if you think of how many times if you've sold premium and just had your ass handed to you, right? There's somebody on the other side of that trade.
Yeah.
So I think it's important to understand, like, when we're trading SPX, like today, there was one, it was a bearish setup. And I remember selling some call credit spreads, but also buying some puts, out of the money puts. And it's a day trade, right? Now the market came down, I think like 20 S&P points. The put options went from 3.5 to 7. And that's great. My call credit spread that I sold for $1 went to 75 cents. So hardly, and it was like $10 wide. So, I hardly made any money on that. So what's the flip side of that? The flip side of that is, had the market just been choppy, right, that call credit spread would have worked. So I think it's just understanding the risk to reward. And there's this idea that buying long options and long puts is for novices. It's like, oh, that's what a newbie does. It's not. If you understand how it works, that's the best way to trade. But you also just want to be conscious of the fact that, if it's a day trade and the option expires that day, not only do you have to be right, you have to be right away. And so you got to just understand, like, when to cut it loose, when to, maybe when to turn that into a credit spread. But directional trading is great. You got to just understand, though, when you're wrong, get out, because that decay will, it'll kill you.
Absolutely. Yeah, it's very great saying that. It's one of my pet peeve of mine. I hear on Twitter people say, "Oh, amateurs buy premium, pros sell premium." Well, not really. Pros sell you premium, but then they're delta hedging. So pros really are neutral, the market makers. And it's just this idea
Right.
of that you can constantly sell premium is just not viable.
Yeah, and I totally agree. I mean, it's just the first time you get in, if you sell an iron condor and it blows up in your face, then you'll know, like, oh, maybe it's not selling premium, because there's always that moment in time. It's like, if you're on the other side of that trade, your option would have been up, you'd have had a 5-bagger in the options. And so I always say it's both. Understand absolutely what selling premium is and what it means, and incorporate that. And a lot of times my favorite way to finance, like, say, a long call, is to sell a put credit spread.
Yeah.
And of course, if the market goes against you, you lose on both. But at least that way you're kind of understanding, like, all right, if this trade doesn't really take off right away, at least I'm collecting premium from this, but the money is going to be made in that long option.
Yeah, exactly. Andrew, I'm sorry I'm hijacking the conversation.
Okay, no, that's great conversation.
I'm fanboying right now, so all my questions are coming.
Great conversation, and I think our audience is actually, enjoying these kind of technical questions and discussions. John, I'm, since 2009 we had a bull market, and it went all the way up to 2021. Yes, we had this bear market of pandemic, which was essentially a V-shaped recovery. For me as a trader, I've always learned how to trade in a bull market, and my whole career as a trader I've been in a bull market. And this is the first dragging bear market that I can see. But I'm sure you've probably seen other bear markets, like multi-year bear markets. How do you see trading now in this environment? Is it easier or it's more difficult? Of course, the volatility is there, but doesn't necessarily mean that it's trading is easier. What's your thoughts on this bear market?
Yeah, well, so the biggest thing in something like this is just to understand that the market has changed. And I always find, there's a saying, the trend is your friend until it ends. You keep buying the dip until buying the dip's like, wow, every time I do this, it's not working. And it's really difficult, especially after, some of those fantastic moves in 2021. It's in our mind, we think of, I'll use Tesla as an example. It's like, wow, that stock always goes up. I think when I look at it, there might be this bias to buy it. But really, it's just, I always say that the best way to test a strategy is to forward test it. So, 25 trades in a row, and how's it working? And if the strategy that was working so well, 2009 through 2021, and all of a sudden it's like, man, I just did 25 trades and I didn't make money. And it's just, this is something different here. And it's just getting used to the idea of flipping the switch. And maybe it is something where it's like, okay, this is a sell the rally market. So one of my favorite things to do is when you're looking at a stock, and I don't know if it does this on every platform, but it does it on Thinkorswim. If you're looking at a chart, you can put a minus sign in front of it and it'll invert it. And what's crazy sometimes is that, normally it's like if someone's been trained to always buy the dip, and if you invert the chart, and say, man, I got to buy that. Well, if you're going to buy the inversion, that means you're going to short, the regular chart. And so it's if you've been trained only, in bull markets like that, sometimes trading off of the inverted chart. I know it sounds kind of ridiculous, but that's if that's how the brain is trained. But ultimately, is just understanding that the markets have different seasons. It may be a long time before we see a bull market like that again, and it's just understanding. So typically in a bear market, the obvious thing is looking more to the downside. But the thing about downside markets, what a lot of people don't realize when they first get into them, is that the rallies and down markets are amazing. The rallies and down markets are faster and harder than they are in bull markets, just because you got all the short covering and stuff like that too. So it's just, to me, in a market like this, you got to bring down the time frames a little bit. Yeah, I'm going to be looking at daily and weekly charts, but more likely keying off, like, say, hourly charts and things like that, and really being quicker to take profits. I guess the biggest thing is you just don't see as many extended runs upside or downside.
It's interesting, not even on the downside. Do you think for new traders, because I see there's a lot of new traders are coming. I was under this impression that after pandemic lockdowns are over, people are not interested in the market. But I personally still see a lot of people coming into the market, new traders. Do you think this environment is easier or difficult, or it really doesn't matter? Is the principles for new traders learning trading?
Yeah, so I think this kind of market is great to come into because you actually learn how to trade. I would say in 2021, nobody learned how to trade. Everybody learned how to buy. So it's like, you open up your Robinhood app, buy your favorite stock, it's not rocket science. But if you come into an environment like this, and because if you think of trading's a skill. And if you learn the skill set of trading in an environment like this, then when a bigger move does come along, you're just going to be better prepared for it. So if you think of, I equate trading to golf sometimes. It makes it sound like I'm a golfer and I used to play and then I had kids and I haven't been on a course since, right? But when you're golfing, it's not about how hard you swing or, it's really just, are you present and are you kind of, present and loose, and it's really like that in trading too. It's, I just find, and I got to remind myself of this too, is that, if I get too enamored of an idea, then I ignore what's actually happening in the market. And so, we have a market right now it's volatile, it's range bound, and it's nervous. And so we want to adapt to that and have strategies that take advantage of a market that's volatile, range bound, and nervous, and not, it's just off and running.
It's amazing. Thank you.
I want to take it back to what you said earlier about kind of market regimes and market regimes changing. And just from our community, one of the things we were doing in 2020 and early 2021 was, prior to earnings, we were buying these straddles or strangles, and all the stocks were breaching their expected move because there was just so much uncertainty and a lot of the earning was being pulled forward. And in 2022, it wasn't working anymore. So like 80% of those straddles were losing money. How a newer trader can understand that shift in market regime change? Because you usually don't see it until it's too late. So, for you, what are some of the things that you look at and you're like, okay, this is a new market regime, new strategies, new kind of skill set is required?
Yeah, and the thing about it is it's hard to see it in advance, and I think the idea that it's like, oh yes, next month things are going to be like this is, that's nobody really knows, right? So a couple of things I'll look at are just things like the VIX. So in 2022, the VIX has been, right now it's at, 20, and it's been there for a little while, and that's a more kind of normal, what I would call kind of a market. For a lot of 2022, you had the VIX at 30. 35. And in that kind of environment, not only does the option premium get spiked up, but just think of it as the uncertainty is out of the window, meaning nobody knows what the hell is going to happen next. And so in that kind of environment, it's a lot trickier. So when you were talking about the earnings trades that were working, you remember the VIX was at 15, 12, 15, the market's kind of, steadily moving higher. Everybody, bad news was good news and good news was good news. So I just kind of look at it as the VIX is kind of a good, it's a good gauge. So right now the VIX is at 20. Awesome. I'm kind of looking at a market that's, it's not trending higher, it's not trending lower, but I'm not looking for any explosions up or down. But when it's at 30, 35, it's all bets are off. You just got to be really cautious. And so that to me is a good guideline of when do I press it and when do I pull back. And by that, a lot of times is position size. So if the VIX is at 30, 35, I'll cut back to trading size by a third. Overnight trading in that environment is a lot riskier. And, that, and so just things like that, you just kind of, a couple of checklists like, okay, where's the VIX? Great. This means I can do this kind of trade.
Love it.
John, I'm a big advocate of part-time trading for at least for our traders that, just keep the job, trade for a couple of hours a day, and the stress is low, less for you as a full-time day trader. What's your thought on that? Do you think full-time trading is possible for a lot of people? What's your advocacy here? I know you're a full-time trader.
Yeah, but there's a couple things that are hard about full-time trading. And so if you have a job that you enjoy, and I think that you absolutely, and especially if if you're on the West Coast, right, and you have those couple hours in the morning, that's kind of a prime trading. I think that's the best of both worlds, for a couple of reasons. One is that if all you're doing is trading, it's kind of variety is the spice of life, and trading can be obsessive. You can become this thing where you're always staring at the charts and kind of starting to forget everything else that's out there because it's easy to get enamored with what's the next move. I think if you're a full-time trader, the thing that you really got to nail is psychology, and it can. There's a reason why full-time traders, if they're newer, oftentimes they make money in the morning and they give it all away in the afternoon, and it's psychological, and it's also just the way we're wired. So part of it is, the longer we're in front of the screens, the more impatient we're going to get, and the more impatient we get throughout the day, the more mistakes we're going to make. Also, there's this thing called decision fatigue. After the fifth trade, it's like, So I would just say that best of both worlds. You got a job that you like, and you can knock out $500 in the morning or 1,000 or whatever your goal is. Best of both worlds. If you do want to make the jump to full-time trading, really, really, really get clear on your goal. Why are you doing this? And if your goal is, and I always like the idea of, if you're trading full-time, I always like to be upfront. You're not going to make a living, in my opinion, on a $5,000 account. But if you've got, say, I always say 100,000 because that's easy. It's easier to do the math. But on a $100,000 account, you're trading options. You can make 0.5% a day. That's $500 a day. That adds up. That is $10,000 a month, right? That kind of stuff. So you're not taking a lot of risks. The way you screw that up is you overtrade. You don't stick to your stops. And that's all psychological. So it's just understanding that full time, the market's designed to trick you. It's designed to make you lose your mind. And it's designed to take all your money away. So you got to understand that. But if you go in, with a plan, and it's like, I'm only going to do this when this happens, and I'm only going to risk this much, and I'm going to follow my rules, and it's possible. There's a thing about that, though. Everybody talks about, so there's a saying like, do what you say you're going to do. So if you say you're going to meet somebody at 3, meet them at 3. And that's how people build trust with you. And that's how you build integrity with other humans. It's so important, though, you got to do that with yourself. So if you say you're going to go to the gym at 3, get your ass to the gym at 3. If you say you're not going to eat sugar that day, follow it. Because when you do that, you learn that you're going to follow your word. You're going to trust yourself. If you don't, guess what's going to happen? You're going to have this trading plan in front of you. You're going to throw it out the window because you have no integrity with yourself, and you're just going to blow up your account. So it's little things like that to get into the habit of just being a full-time trader.
Amazing, thank you. Since we're in this topic, Adi, I'll take the next one. You mentioned psychology. Recovering from a big loss. I personally had a $2 million loss last year. Public, everyone know that, and it was in front of everybody. And I know you told the story that earlier in your career, you had something like $180,000 down payment of your house. You blew it up. It was something like that. So you had that as well. How do you recover from a big loss?
So big losses aren't fun, right? They're part of it. And certainly since then, I've certainly had trades that didn't work out. It's like, okay, that wasn't fun. That one about the house, that was, that was a big deal because at the time that was like all my money. I was like, oh my God, it was going to go towards a house. So it was, it was a super emotional event. So the thing about there's a couple things with a big loss. And one of the things is just understanding that, you don't want to live with it too much, because it's just, you wake up every day and it's like, oh my God, I got to make up this money. I got to make up this money. And the best thing I've ever heard of it described is just consider it research and development. So everything up to now was research and development. That's stuff that you learned. Now you know what the market is capable of. You're going to forgive yourself. You're going to start with a clean slate, next trade, and you just move forward. And that's just it. And the thing about people that have never had a big loss is they don't understand that that's what the market is capable of. And so, you got to get it out of the way. And there's this great saying too. There's, I think it's with pilots too. There's old traders and there's bold traders, but there's no old bold traders. And at some point, getting into, and I certainly will push it and take some risks, but I do find that, at some point you're kind of moving along going like, well, maybe I only need to trade 200 contracts, or maybe let's drop it down to 20, and you really get dialed into why you're trading. And I find, for me personally, anytime if I have a big loss, it's usually because I'm pushing it too hard. I have too strong of a conviction that something's going to happen. And if I go back and look at it and say, well, gosh, I could have traded half the size, I could have gotten out here. And it's just being objective about it, so that the next time, because you don't want to go into the next trade being fearful, but you want to go into the next trade fully understanding what can happen on the downside. And so you just look at that as kind of a blessing. It sucks, don't get me wrong, but it's a blessing. And it's, it's one of those things that you learn from it and you move forward. And that's part of your skill set as a trader.
Excellent. Thank you.
Yeah. Andrew, if you're okay, let's get into some of the stuff that is happening in the market.
Yeah,
for
sure.
With you, we have tons of stuff's happening. John, I was reading recently that in 1996, so like 4 years before the peak of .com bubble, Alan Greenspan came and said the valuations are irrational.
Yeah.
Where are we, do you think, in this bear market? Like, have we kind of bottomed? Is this a new bull market? Are we too early? There's still more downside. Where do you think we are?
Yeah, so there's a cycle that I follow, and there's this book called The Secret Life of Banking and Real Estate. And I met this guy. I was in London, and it was a long time ago, like 2004. I was giving a talk, and this guy, Philip Anderson from Australia, was giving a talk, and I went and sat in on it, and it was fascinating. And he was laying out how there's these real estate cycles, and this will get to where we are. And this was in 2004, mind you. And he was talking about how in 2008, we're going to have this big real estate crisis based on credit. Stock market's going to crash and all this stuff. And I was kind of like, yeah, I've heard all this. I hear a lot of stuff. And of course, it played out exactly like he said. And so according to him, and according to that book, there's a cycle. It's based on credit creation and all that kind of stuff. And it drives politics too. Like when you see, after you read this book, you don't get mad at politics anymore, because you just know like, oh, this is where we are in the cycle. People go insane at this part of the cycle. So according to his whole body of work, then the next 2008 style kind of market would be like mid 2026. All right. So, is it going to happen exactly like that? Who knows? I kind of think it will. So what does that mean for today? So I see a lot of fear. Oh my God, banks went under, Silicon Valley Bank. Oh my God, is this 2008 all over again right now? I personally don't think so in any way, shape, or form. I do think that if we're going to talk about where we are in comparison to 2008, I think we're in like 2005. Believe it or not, I don't think real estate market's going to roll over and die here. I think we're going to see, there's a lot of people forget in January, there's a $1.2 trillion infrastructure bill passed. That money is being deployed to build stuff. So it's scary because of the headlines, but I don't think we're going to see anything really nasty until a couple years down the line. Now, does that mean right now that the stock market has bottomed? Is it going to go lower? I kind of think, this reminds me of if you were looking at, say, an hourly chart of Tesla, for lack of a better stock, and it ran up 20 points, it's going to spend the next, let's call it 10 hours consolidating. So if we look at a monthly chart of the S&P 500, it's like straight up for 13 years or however long. I think it needs to spend a couple of years consolidating. So I think we're going to be stuck in a range in the S&Ps. Let's call it 3,600 to the downside, 4,300 to the upside. And we're just going to be stuck in there. And so what does that mean? From a trading perspective, that's great. That's fine. From a buy and hold perspective, it's tough. In this kind of environment, what happens is that the indexes chop around, but specific sectors and specific industries do really well. So you're seeing energy doing really well. The boring stocks are kind of doing well. Tech stocks not so much. So I don't think this is it's a situation where, and at some point what happens is we get back to quantitative easing, and that's when all boats are lifted. So crypto, crypto was sold as an inflation hedge. It's not. It's a speculative asset, and when the government starts cutting rates again, crypto will do well. Tech stocks will do well. So it's just understanding that that's the environment. It's perfect for a trader. It's not easy for someone that's just buy and hold.
Yeah, it's as we say, it's a nightmare for investors, but it can be a paradise for traders, the people who actually know how to make trades. John, you mentioned that, for example, if someone wants to know, the best way of testing a strategy is forward testing. Do you recommend trading in a simulator, or no? You think that that 25 trade that you mentioned, for example, as an example, it's better to be in a live trade, small size, to test it yourself?
Yeah, so the reason I'm not a huge fan of simulation or back testing, it's okay to run back tests just to get a general idea. But if you're in a simulator, and it's good to run a simulator to understand the software. Like, you don't know how the platform works, okay, do some trades. The problem with the simulator, though, is that you do not understand how you act in a trade, and that's like half of it. So it's not just the setup, it's how you behave while you're in a trade. So there's always kind of like, Nancy Reagan had this thing in the whatever, I think it was the 80s. This is your brain. This is your brain on drugs. You got to understand, like, this is your brain and this is your brain while you're in a trade, because, your psychology changes, and you will not learn that about yourself unless you're trading real money. So I think it's good, do a couple of trades in a demo account. It's actually good to understand how you are in a demo account. Typically, we're all pretty neutral. And then once you throw on a 10 lot, you start freaking out, because that's going to impact as well. And the goal is trade a size where, you're kind of close to, or train yourself to kind of feel like you do as if you're in a demo account. And if you're freaking out, it usually means you're trading too large. And it's just kind of finding that right mode there. So that's why I believe in forward testing, because you're testing the strategy on a go forward basis, but you're also learning how you do. Did you follow the plan? Did you get out too early? Did you take your stop? And that's absolutely part of the setup.
Thank you.
Yeah. Especially with option trading, the simulator, it's nowhere near the real thing, because the fields are not as fast, and you really want to.
Yeah, you could fill a 5,000 lot butterfly on Google on a simulator. You'd never get that in real life.
Exactly. But I'm telling people, I'm like, simulator is good, but for options, no, you have to take a few contracts to really get a hang of it. You mentioned market cycles and interest rate, and it's so interesting. A couple of days ago, I was watching a video on the Minsky cycle. That this credit cycle.
Which cycle?
The Minsky cycle. He won the Nobel Prize. Basically saying,
okay,
we keep pushing the credit to the side where it no longer is covering the interest nor the principal. Then we have to bring the rates down. Happened in the 1990s, in the 2008. So kind of on the same topic of, rates coming lower, have to kind of come lower. Andrew and I have this trade, and I want to get, pro's opinion on this. What I've been doing, I feel like TLT is really set up for a rally this year, with basically a play on rates. 30 years at 3.5. Historically, it should be somewhere around 2.5%. That puts about a 17% rally on TLT, kind of fundamentally looking at it with the duration. So what we've been doing is we've been selling puts, monthly puts on TLT, and buying long dated calls, kind of play on the rates and kind of economic slowdowns. Coming from a pro from you, I would love to get some critiques or feedback on this trade. What do you think?
So I like the idea. I always find fundamental trades tough, because a lot of times, the fundamentals play out. It takes a lot longer for the fundamentals to play out than reality. I mean, that's the only thing, but you're spot on in terms of, a recession trade is betting that bonds go higher, right? So what you're doing on TLT is exactly that. The question is, when does that hit? And I think what's interesting right now is that, I think if you talk to anybody, myself included, looking around going like, well, the economy, you can see signs that things are already kind of rolling over. But the statistics that the government's looking at are in the past, and so are they going to overclock continue raising rates and making things uncertain, and that jerks around TLT for a little bit. But at some point, when there's that tipping point, then absolutely. I mean, TLT, bonds go higher, interest rates go lower, and it's just it's the question of when that goes. The big traders really like what's the euro dollar trade, and I mean the bonds, not the currency, where it's like, oh wow, we're going into a recession. Euro dollars are at 96. That means they could go back to 100. So you can buy these, they're so liquid that you can just buy so many of these, like say $98 call options. And there's traders that'll do that, and it's like hundreds of millions of dollars on the line, but they see everything lining up and they just go away for a year and come back. And so that kind of reminds me, of what you're looking at here. And it's just being able to kind of play the wiggles, while that plays out. But yeah, I like the idea.
Oh, there you go.
Awesome. There you go. So, John, I have a question. It's a little bit personal. Feel free not to answer. But how do you diversify your own investments and portfolio? I know you have probably a big trading account, real estate. You have. How do you the money that you're not trading with? How do you diversify it, you personally? And I know cannot be generalized to everybody, but I would be interested myself to know.
Sure. Yeah. So I find that because I spend so much time in the market, I want to get the money out of the market. So and that's just a conscious decision. So my general setup would be, here's my trading account. I try to generate income from it, and then I extract it from the market, meaning I take it out, and then I'll put it into real estate. I do like gold and silver and rare coins. That's just kind of a thing that I like. It's not necessarily the best idea. But I'm a huge fan of, like coins that are, like this is the best graded coin of this series. And it's like, that's something that it tends to, every time it exchanges hands, it tends to do it at a higher price. I do we have some account that are in index funds. It's more that I don't really watch. And that's more of like, okay, this is a kid's college fund. It has to be invested in something, that kind of a thing. But generally, I kind of look at it as, in terms of diversification, being able to just to kind of, if I've got money out of the market, that means the market can't take it from me. And if you look at, there's something called John Bogle, the Bogleheads, where they're like, no, you put all your money in the indexes, and then, you can take out 4% a year. I mean, that's great. In the last 13 years prior to last year, that's been this amazing thing. And, I always question, because I've seen markets where, after the NASDAQ crash in 2000, it didn't get back and break out the highs for like 12 years, so I've seen that too. So I'm not, the biggest fan of that, but that doesn't mean it's wrong. But my philosophy is make money in the markets, take money out of the markets, and then put it into real assets.
John, I want to get your opinion, and I've been asking this question from every guest we've had, on how we handle SVB and the unlimited insurance and the moral hazards that go with it. And on my Twitter account, at least, I'm trying to keep it professional as much as I can, and just keep it to like really concentrated on the markets because the brand I'm trying to build. But when we did that, to me, it just felt a little. I mean, I know they didn't have a lot of choice, but it felt like we really bailed out a certain group, specific group of VCs. There's no more, realistic reason for a bank to be a good bank and hedge their interest rate risk, because now that all the depositors will get bailed out. How do you think we handle the whole SVB debacles, and how do you think the Fed handled it?
Yeah, so I think that we just have to understand that the powers that be, just whoever that is, they are not going to let a bank fail. I mean, that just causes so many problems. So we just have to understand that's the first thing. I kind of look at that, and there is kind of the, oh my gosh, it's VCs, but it is a lot of, if you look at Silicon Valley Bank, it was a lot of depositors, like these are small businesses. So there's some VC-backed companies. There were some companies that had a lot of money there, but a lot of it's small businesses. And I know some of the owners were freaking out that weekend, like I don't know if I'm going to make payroll. So the idea that they woke up Monday morning and they knew that their money was safe, I thought was a huge plus. So on that particular one, I kind of looked at it as all the companies and all the employees that were going to be paid that week basically were covered. Now, a bigger argument is, well, is this now opening the behavior for this to happen? I don't think so. I think what happens, what I've seen in banking, is that mistakes happen, and then they fix that mistake so it can't happen again, and then a new mistake is made. But I think the idea, I mean, in 2008, I thought the financial world was coming to an end. I was like, we have gold, we got our canned goods, like everything's going to implode. And I sat back and watched. The two things that I always remember is that, one, they just fixed it. They're like, we can't let this fail. We're going to throw money at this. You're going to buy Lehman's, you're buying Bear Stearns, and they just made it work. And then two, it's important to understand that when a bank like that is having issues, how many people is it impacting? And I just remember in the height of the 2008, even 2009, when I'd go to the movie theater, it was packed. When I'd go to Target, it was packed. And there's so many people out there that are just going along and doing their lives. And it's sometimes it's hard to remember. It's like, oh my God, the market's down. Everybody, it's going to be this huge wave of zombies attacking everybody. It's like, no, it's not. There's a lot of people out there that, don't have exposure to it. And I'm not trying to be flippant, like, oh, there's not going to be any problems or anything like that. But we just got to understand that the Fed has the ability to print money. And as long as they do, they're going to not let banks fail. And I'm not saying that that's a good idea, because at some point it's like, how much debt is too much? 50 trillion, 60 trillion. But the idea of letting the economic system and the credit system fail, the repercussions of that way, way, way outweigh, they would rather just keep that can rolling. So I personally think it was the right decision, only because if there's suddenly a run on the banks, that's a problem for everybody, not just the VCs at that particular bank. And so the idea that everybody could wake up and feel like, what, my money's safe, I can go to work, and I don't have to stress about this.
Yeah, I mean, we were talking about no bank, no matter how well capitalized or how well ran they are, they can't stand a bank run, right? That's just not how banking works. So
no bank can.
Yeah.
And that's an important point. I think a lot of people don't realize that. And I am a huge fan of, like gold, silver, and stuff like that. I don't, I remember reading, I think it was a book, it was an autobiography or a biography of Warren Buffett. And his dad in the 40s was like, gold, banks are going to go under and stuff like that too. So there is this kind of history of fear, and you got to hide some stuff under the mattress, and it never seems to, to pan out. Yeah. So I think it's just one of those things where you just kind of spread your risk out. Yeah, we need money in the bank to pay bills, but also just like what happens in the event that for some reason the banks aren't paying out anymore. That does happen in other countries around the world. And so I think it's just something to not be too panicked about and not be too scared of, but be prepared. Just like, all right, I've got some of my savings in hard assets over here. I got some money in the bank. Because the other side of the coin, and I've got friends and clients who do this, is they're absolutely convinced the financial world is coming to an end. And one guy I know, he's been living underground in a nice house in like Arizona since 2006, and he's still there waiting. He's like, yeah, it's going to happen any day now. I'm like, how much life you missed out on hiding out in Arizona? So, there's that fine line, right?
Yeah, exactly.
John, I have a question. What you mentioned family and the college funds, and that struck me. I had one trader who mentioned that to me, that the money that I'm trading is for my family, is the life saving and everything. And he had trouble making peace with taking risk on that account, knowing that he's trying to make money for his family, but also he has to take risk on the family savings. So I don't know exactly what I'm trying to ask, but I guess there's no question. But I want to know that, how do you handle the situation that you have to risk family savings to make money for them? And how much your family actually know or knew when you were trading about the risk that you're taking with the money? And because that does impact a lot of people's family. I don't know exactly what I'm trying to ask, but that was just a comment that I'm asking.
Yeah, no, I think I get it. So the one thing is, first of all, with non-traders, if you try to explain to non-traders, what you do, it's like, yeah, well, I'm risking 5,000 to make 10 on this. They're just like, what? That just, a lot of times that just scares people. So that answers your question, like how much to explain kind of what's going on. But that being said, so let's just say, again, let's just say you've got, let's call it 100,000 is just an easy one to do numbers with. Let's say this is your kid's college fund and you're just trying to grow it. All right, so what kind of trades are you going to do on something like that? And so this is the thing where you really kind of get dialed into discipline and sizing. Because on something like this, yeah, it would be amazing if you could 10x it, over the course of a year. But if the risk to 10x it is it goes to zero. And so you really want to get dialed into what's an appropriate risk here. And so I always think with stuff like that is, asymmetrical risk, meaning, okay, so I'm not going to go long 10 futures contracts overnight with no stop, or even with a stop. I mean, there's so many bad things that can happen in that situation. However, here's a butterfly, where if this doesn't work, I'm going to do a 10 lot butterfly for $1. And if this doesn't work, the worst case scenario, I lose $1,000. Best case scenario, I could make 10, that kind of stuff. And so I think it's one of those things where you just want to set it up where the worst, you got to know that, assume the worst thing that can happen, and you set up your trades like that. And so I'm a huge fan of, this would be a case of like, well, I'm not going to, if I do a 2 standard deviation spread, yeah, it may work out 94% of the time, but that one time it doesn't work, it can take the whole account down. So it's not worth it. And it's just getting your arms wrapped around that. And this is where you really get dialed into not trying to be right, it's really just understanding what is the worst thing that can happen, and assume that the worst thing that could happen, and then set up the trade based on that.
Yeah, perfect. Thank you.
I mean, it's all about taking reasonable risk, right? Especially with options, it's a lot easier because you can really see the probability distribution and really kind of calculate your expected value based on the distribution. You could do that. So, yeah, you're absolutely right. John, I would like to ask one technical question, and it's about your indicators that our viewers can get them on, Thinkorswim or Interactive Broker, whatever broker you're with, and the TTM Squeeze. Can a trader, and I've been playing around with it myself, I know you mostly take them directional, but can a trader, when they see that TTM Squeeze, maybe do a straddle or a strangle for that volatility outburst because they think, okay, now volatility is going to expand?
Yeah, so I really like that for a couple of reasons. So let's say that you've got whatever chart, daily chart, SPY, and it's got a squeeze on it, right?
Yeah.
So there's a couple things there that I really like. When there's a squeeze, that means that the volatility has really gotten quiet. So that's a good time to buy options. So, and I've certainly done this before where it's like, okay, there's a squeeze. I think it's going to go to the upside. I buy calls and, boom, it gets whacked. And so doing a strangle at that time would have been better. So I like the idea of that because typically what I look at as a squeeze as increasing the odds of a greater than expected move. And that's when you're going to make money on a strangle, right? So the nice thing is, is about a straddle or strangle, you're not too worried about the direction. You just want it to have a greater than expected move. And I've even seen times where, maybe it flushes down first, great, sell the puts, and then maybe it recovers, that gets a little trickier. But the overall thing of, when there's a squeeze like that, it just means that it's a great time to buy options. The volatility is compressed. The implied volatility on that particular instrument has also compressed because of that. And it's, it's a good time to do it. I tend to look at things. So right now, there's a squeeze. I'm looking at the SPY or SPX, and there's a daily squeeze on it. And I don't know if that's going up or down. Like it could go up 100 points. It could go down 100 points just based on the pattern. It's not a clean pattern either way. I personally am looking for kind of a spike up because everybody's so bearish. Like let's spike up and then, and then roll back over. But I think that, in that type of a situation, and the VIX is at 20, some longer term strangles, 3 weeks out or something like that, I think makes sense on SPY right now.
That's so interesting you mentioned that because that's a trade I have on right now. It's at the money straddle, and exactly same thesis. I think I also saw the squeeze, and I feel like we're gonna break out. I don't know the direction, but yeah, it's very interesting.
Awesome. I'm good. Yeah, go for the next one.
John, so many questions I wanted to cover. So let's take a look at the list.
Maybe you can ask one last question because I don't want to waste John's time much longer.
Absolutely.
Thank you so much for this time, John.
Yeah,
for sure. These are great questions. Good discussion.
I want to talk a little bit about market structure, and I don't want to say I'm like your friend who is living underground, but I'm always looking for mispriced opportunities or what market is really underpricing. And there's a lot of talk about, the inherent risk with 0 days to expiry options, and, the dampened volatility because of them, because a lot of the retail is selling. I don't know how to read this, and I wanted to ask a pro in market structure like you, how do you see the massive boom in 0 days to expiry, and do you see any inherent, like, let's say, a systematic risk with them?
So it's a good question on the systemic risk. I don't see that so much, just because, especially since they're cash settled. And this is a new area, right? So I mean, and I'm open to different ideas on this, but I look at it as like, okay, it's cash settled. People are, for the most part, selling naked SPX options is hard for most people, and it requires so much margin requirements, right? So most people don't do that. So they're doing spreads. So that takes out some of the risk out of it. But I absolutely think it is, what's happened in this market is, I think the first 2 hours of the day are awesome to trade, and the last 2 hours are just like, what's going to happen here. I think all that is driven by the flow there. And I think that the 0 days to expiration is, it's pinning levels every day. It's preventing breakouts. It's even preventing breakdowns, and it's keeping things in tight ranges. And so I absolutely think it's impacting the markets.
Yeah. It's, speaking of that market regime and stuff, I know a lot of traders that are making really good money with 0 days to expiry, and I tell them, enjoy it right now, because there might be a new market regime in a couple of months, or a couple of weeks. Yeah.
For sure. Yeah. And it's always good when something like that comes out, you take advantage of all that you can. Sometimes it's like, if the machines take over, it's like, things maybe, I think the worst case scenario for this is everything gets really tight and it just stays compressed for a long time. And that's something that I've seen, especially as the volume has just exploded. We were seeing these huge ranges the first half of 2022, and then 1.0 DTE came out. It's almost like that crushed the volatility right there. And so that may be something that keeps the market in check for a while too.
Yeah, it's so interesting, because I was listening to top strategists at Numera at the derivative desk, and he was saying one of the favorite strategies right now that hedge funds are doing at the beginning of the day, selling at the money call, at the money put, and they're letting it kind of expire worthless, because, as you mentioned, especially the last few hours, just SPY comes back to that narrow range. So really interesting stuff, dynamics of the market.
Well, and I think if you look at the big round numbers right now, like 3950 SPX and 4000 SPX, you tag 4,000, you magically drop back to 3950, and it's just, bing, bang, and I think that's something that's going to continue for a while.
Absolutely.
So, John, you don't see any systematic risk to the downside that much. You believe that the market might stay volatile, but in a very range bound in the next 6 months or so. Is that?
Yeah, and I think that, a lot of people I know are pretty bearish. I'm not super bearish. I'm not bullish, but I think the capitulation already happened. So I'm just looking at a chart here. So June, like the second week in June, the S&Ps went from like almost 4,200 to like 3,800 in 1 week. It was like, I think, the second fastest and largest drop in the S&Ps in the history of the stock market. And to me, that was actually capitulation. That was the bottom. And since then, I know we took out new lows, but it's been much more kind of an ebb and flow. And the reason I say that is, when you see capitulation like that, it just means that a lot of people that were, involved in strategies prior to that were blown out of the water. That's margin calls, that's panic. And you really need that big high volume panic to kind of set the tone. And so I think that actually then just kind of set the market to a new normal. And since then, we've just been getting in tighter and tighter and tighter ranges. Now, look what's happened. We had Silicon Valley Bank, basically this huge panic. What happened? The S&Ps did nothing. They were down, 40 points. So you see all this bad news happening around the world every day, and the stock market isn't falling apart. And so I've always paid attention to that, when it's like, it seems like the market should be falling and it's not. It just kind of, to me, that just gives me a lot of information. Like, it's priced in. The market's very, very smart. It's looking 6 months ahead. And it's like, yeah, we got a couple banks over the weekend that failed. Not a big deal. And, and so I think it's just really important to understand and just kind of look at how the market is reacting to news that we think should either A, send it up, or B, crash it. And if it's kind of, that just says a lot about the market.
Amazing.
Absolutely. I know we're running out of time, so I got a little fun thing I like to do with the guests. It's a 3 thing. I call it start, bench, cut. So you know how you start a player, bench a player, cut a player. Right now, if you had the option of cash, bonds, or equity, who would you start in your portfolio? Who would you bench, and who would you cut?
Okay, that's a good question. I would say, okay, so let me clarify. So do you mean like you're holding something for the next year, or
Yes,
just like the next day?
Let's say next 6 months.
Okay, I would say, especially with interest rates at 5%, this is a long-term hold. Cash is first, stocks are second, bonds are third. So bonds, bench.
I like that. Okay.
Oh, that was nice. Thank
That
you.
was nice.
Yeah.
And I got one for commodities because you said you're more of a hard asset person. Gold, copper, and lumber. Who would you start? Who would you bench? And who would you cut?
Yeah, boy, I would start gold. Copper is tricky because, you know, recession, copper. Hold on, now you're asking me these questions. I gotta look at this chart. HG, copper. Okay, so I would have to do gold, copper, and then lumber.
Oh, that's exactly what I would do. Yeah, exactly. Yeah,
Which one? Say again.
Gold, start gold, second copper, and then lumber last.
Lumber then.
Did I get that correctly?
Yes.
Gold, copper, lumber. Yeah.
Gold's been on fire
Yes.
recently. Yeah. With all
Yeah,
the
gold's
banks.
fascinating here. I want to see if it can. So for squeezes, there's a huge monthly squeeze on gold. So I keep looking for that if it's going to fire and take us to new all-time highs in gold, at least against the dollar.
I would love to take that trade with you. Some long calls GLD. I'm also waiting for a breakout. Andrew, I don't have any more questions on my end. Are you?
That's it. Thank you so much, John. That was an amazing discussion. You are a very charismatic person. You're a very great speaker and very knowledgeable, and I really look up into you. Thank you so much for having this time, and I'm sure that our community and our followers would love to hear more from you and potentially follow you. You're still very active with simpler trading. Is that correct? So if they want to come and learn from you, that would be the place.
Yeah, no, we do focus a lot on options trading at Simpler Trading. So we have our there's a gold options room. That's where I kind of go and post my trades and stuff like that. And then Twitter, just John F. Carter. But that's kind of I generally I've got my 6 monitor set up here, and look at a couple of trades. We'll post them in our room, and then just do a few things like that, and just try to keep it pretty simple.
Perfect. Thank you so much for having a chat with us, John.
Yeah, absolutely.
For sure. No, thanks for having me. Great questions, and I like what you guys are doing.
Thank you so much. It was a pleasure, and sorry if I fanboyed a little too much. Again, it was a great moment for me, meeting you. Yeah.
Yeah. Again, thank you so much, John.
Have a good one.
Okay. Yep. Have a good one. Okay.
Bye-bye.
Yeah, it was a great conversation. I actually loved it. He's a very, very nice, speaker. Very charismatic, very knowledgeable. He's a really great guy, and I think everyone should really get a chance to go to one of his actually presentations in real life. I think you're going to Money Show, and it might be there. Yeah.
Yeah, absolutely. So I'm actually really excited. I didn't want to tell him in the interview that I'm gonna also be on the Money Show, but I would love to, meet him. He's, as you said, very humble and one of the pioneers of the industry, right? Who has actually started the retail trading community, and fantastic. Fantastic trader. Some of the key takeaways from this conversation, I think one of them was he's expecting a range-bound market for a little while, which is, I wouldn't say it's a consensus, right? A lot of people think we go lower, but he's thinking maybe the 3,600 to 4,400, consolidation. And the other thing, you asked a really good question about, risking families' money, and stuff they talked about the risk really stood out with me, that it's okay if you're risking families' money, just don't take aggressive risk, right? Just know how much you're losing and just know your system, basically.
Another thing that he said that I loved was that, having integrity in a society, like when you're saying someone 1 o'clock, it's 1 o'clock. When you're saying I meet you there, you meet that person there. So you have to do that with yourself as well. You have to stick to your rules that you set for your own trading. So you should have that integrity for yourself, which goes into the discipline for trading.
Yeah, absolutely. Yeah, and he gave us a thumbs up on the TLT trade. So he said he's not sure about the timing, but it should work. So hopefully it will work.
Yeah,
so.
that's amazing
Yeah.
that he mentioned. Another thing that I really enjoyed from his talk was that the money that I'm generating from trading, I'm taking it out of my trading because I don't want market to take it back from me. That's one thing that it's reaching the point that I had that problem with the TNA trade, that when you're reaching to a point, if your money is growing in your account, you should take it out so you don't do anything crazy with that money. Yeah. Another thing that I really like that is that the people who've never had a big loss, they just don't know how capable the market is to do something to them, and it's very, very interesting. I love that.
I think the more you trade, the humbler you get. Like for me, like I hear all these people saying, "Oh, premium selling," but as someone who's been on the wrong side of premium selling, I know how vicious they can be. So it's always, it comes with a little bit of experience, and who's more experienced than John Carter, who we talk with. Yeah, it was fantastic. If you have the option, I'll put my link in there. Use my link, sign up, and you can actually go to John's presentation at the Money Show. He'll be in Vegas. If you're in the neighborhood, make sure to join us. I think few of the BBT mods are joining as well, so we can make it a little BBT community as well. But fantastic conversation, Andrew. Thanks for setting it up, and thanks for asking me to be in it.
Well, thank you for great questions and discussion. Thanks, guys. And if you enjoyed this video, feel free to subscribe to our channel and give us a thumbs up. And if you have any questions, just leave it in the comments. Adi and I personally read all the comments, and we'll get your questions answered.
Yeah, fantastic. Talk to you soon.
Talk to you soon.